All right, so wait and watch is what Neeraj is suggesting. In fact, to discuss what's setting off this global meltdown, we are now joined by Chakri Lokpriya, Managing Partner of Red Strawberry, Sunil Subramaniam, Market Veteran, and MK Global's Chief Economist, Madhvi Arora. Good evening, all of you. Thank you for joining us on this broadcast. Madhvi, coming to you first. Now, we have seen this mayhem in the Indian markets, and before that, of course, the Asian markets went into a tailspin earlier in the morning. This current turmoil began, of course, with the Bank of Japan's rate hike last week. Help us make sense of what we've seen today across the Asian markets and the Indian markets.
So clearly, I think, the Goldilocks narrative, which was being sold off until almost a month ago, has, sort of toppled. Market was, actually enjoying the narrative, which was basically based on the fact that you would see policymakers cut rate despite a relatively healthy growth. And that narrative was sort of floating the market apart. What we saw in the last 1 month or so, 1.5 months or so, has been a confluence of various factors. One is, of course, the macro data has started softening. I don't think it's in a situation that you can actually call it a hard landing scenario. But, the narrative is slowly changing towards a weaker labor market, which it is, especially after having seen last week's labor data in the US. And more importantly, the divergence in the policy making within the developed market space, with Bank of Japan, finally moving away from its accommodative policy stance and looking to further hike rates in the coming months or so, which clearly has meant that the yen carry trade has sort of unwound to the extent that Japan, which is one of the key investors in the US treasuries market, especially with Japanese life insurance firms, which are a big chunk of players in the US treasury markets, are now looking to obviously come back home because a large part of their portfolio is also unhedged. This kind of carry, unwind essentially has led to a lot of panic in the markets, of course, be it Japan or even in the US, and especially with the narrative, which is now moving towards a panic situation more than a macro, disaster per se. I think it's more a panic at this point in time, where the market is now calling for a massive cut by the US Fed to the extent that we are market is now expecting more than 100 bips cut in the next, 3 months or so by the US Fed, which obviously would, catamount to a panic situation in the US economy, which I don't think is currently warranted at this point in time. But clearly, the change of narrative has led to, market positioning getting a little disturbed because nobody was really pricing in a scenario wherein the Goldilocks would be disturbed to this extent.
Madhvi, of course, there seem to be U.S. recessions concerns, that are also capturing the global markets. And essentially, that's what set off this sell-off. The employment data didn't look too good. But do you think that this may just be a bit premature? Because that's what I read from what you were saying, that we are perhaps reacting too early to it.
Yeah, I agree with you. I think to a large extent, this is beyond just... in the macro situation, it's a part of it is largely panic at this point in time. There is, of course, slowdown in the US economy, which was anticipated given the tight financial conditions that the economy has been experiencing, even with a comfortable fiscal. I think to a large extent, there's been an irrational panicking that you're seeing in the markets globally at this point in time.
All right, let's also bring in Mr. Subramaniam into this discussion now. What are you looking at? How do you perceive what's happening? It's, we wouldn't be wrong to say that this is almost a global sell-off. We're, of course, waiting for the US markets to open at about 7-ish. But largely, it's not a good day. Everybody in the red, including, of course, me.
I didn't find a red shirt to put on. No, but I have a slightly different take to what Madhavi is saying, and I'll tell you where the difference is. So I'm not very sure that it's as much a reaction to the US data. I think it's more of a reaction to the Japanese rate hike. Now, I'll tell you why I'll say this, because even if you take India, right, as per my estimates, a quarter of the FIR money that flows into India comes from Japan. Roughly half comes from the US and another quarter comes from Europe. Chakri can reinforce this. If he has a slightly different thought, he can say it when he talks. But that cost of funding for a Japanese FII, because hedge funds leverage money and they borrow on a floating rate basis. So any rate hike comes immediately hitting. And so it's very similar to, let's say, a margin trader in the Indian stock market, right? So there would be bankers who would be calling, because the margin of safety will get breached because the cost of funding goes up, and they would be actually forcing them to sell. That's number one. Second is algorithmic trades. See, a lot of these hedge funds and other players, what they do is they feed these data into computers and set these stop losses so that they protect themselves from a fast fall. And those computers actually trigger it. There's no human intervention. So for me, I think it's a greater Japan effect rather than as much the US effect. And why Japanese market fell so much internally was also because the strong yen hurts Japanese exports, and the US is the biggest market for. So if the US is going to slow down, then Japan is going to get hurt big time, and that's why you saw South Korea also getting hurt, Taiwan also getting hurt. So the export markets into the US get hurt, and that's where if you see in India, normally IT is a safety sector, but IT got hurt because IT is again exposed to the US. So to me, I would put a slightly greater weightage to the Japanese decision to rate hike and lead to the strengthening Japanese yen as a bigger trigger. And because see, ultimately a US rate cut is something an equity market should welcome, right? What's happened? There is a subtle difference, is that a rate cut which comes from a control, from an inflation perspective, that is, inflation is easing, so I cut rates, is a positive signal. Whereas recession is coming and so I'm going to cut rates is a negative signal. But that being said, let's take it a month or 2 months from now. And let's assume this 100 basis points rate cut is actually going to come through. The equity markets would welcome it. And I would see that that cheap money would again flow back in from the US into emerging markets, and India would get a benefit. So this is an initial knee-jerk reaction on this situation. Otherwise, equity markets love rate cuts, love softer interest rates to help them to margin. So for me, it's a Japanese thing which has been a bigger trigger today, and and then the overhang of Israel-Iran. That's generally a nervous factor, so which is also hitting it. And where the US recession is actually hitting is probably in terms of metals, global cyclicals, crude, those kind of things, because then that's going to mean that there's only a softer demand. Because already China is already going through a slowdown. So it's my summary. That's why I slightly differ to say that I would give a greater importance to the Japanese decision in this whole sell-off globally.
Right, Chakri Lokpriya, if you could come to you next. Now, do you agree with that assessment that Mr. Subramaniam just made? And also, if you could weigh in on the impact of the yen carry trade, is that also a factor that is rattling the markets, perhaps?
Hello, good evening. Thanks for having me. I would build on what Sunil just said. I tend to agree with him because, what is a yen carry trade? A carry trade is when an investor borrows in a low yielding currency and then invests it in a higher yielding currency. And such trades are usually leveraged. And so when the trade unwinds, the first thing a leveraged investor does is unwinds those leverage positions. When those leverage, so which means this does not impact the longer term deals that are entered into by, let's say, India with Japan or Japan with other countries, but the initial carry trade is what impacts. And the money that is invested by Japan into the US treasuries, not all of it is carry trade. There is a certain amount of a very stable money, but only the leverage rates get unwound, and they get unwound in a hurry. And that's exactly what we saw today. And the impact of that, as Sunil said, is that, when the Japanese yen becomes more appreciates, then the exports of Japan into the US hurts. So it has a reverse effect of slowing down exports from Japan and therefore hurts its balance sheet. And then on the other hand, you have, why is US, now where did this whole thing start off? Is US had a slightly bad unemployment data. They said they were going to cut rates in September. So they penciled in probably September 25, November 25, December 25. That's roughly 75 basis points. Now with, what the Japan did, they might front end, but some end of that 75 basis point cut in the US. But does this impact the US balance sheet? No. So they would wait and watch. Now, Would it impact other countries like India in particular? Not so much, because carry trades are not an integral part of our what you call trade flow. Our trade flows are priced differently.
All right. We are going to slip into a very short break, but on the other side, we are going to ask all our guests what their advice to investors is. So do stay with us. We'll be back after a short break. Well, thank you very much for staying with us on Profit 360. You're watching the big story on the mayhem that we've seen in not just the Indian market, but also Asian markets. We have Madhvi Arora, Sunil Subramaniam, and Chakri Lokpriya with us. Mr. Subramaniam, how susceptible do you think is the Indian market to these global factors? Now, we saw a nearly 3% intraday fall. Are you expecting this volatility to last a little bit longer, given the weak data that is coming in from the US? And of course, there is a lot of geopolitical tension that's still around.
So, couple of things to give clues to that. So first is, I think that the Dow futures are showing a pretty sharp drop. So it means that the drop, or I wouldn't call it carnage, but the drop in the US is going to sustain. So which means there will be that spillover effect on India. Second is that I would also point out a slight difference. The reason I focus on Japan so much was because if you see the Friday fall, Friday also the market corrected, right? The Friday fall, the large caps fell, the mid and small caps didn't fall as much. But today's fall, the mid and small caps have fallen greater than large caps. So generally, when you have an international related sell-off, it's the large caps that tend to fall because mid and small caps are out by domestic buying. Why today did mid and small caps fall more? There are two reasons for that. One is the fact that Japan, last year, I remember they raised a lot of money from Japanese investors, Japanese FIIs, which were large and mid-cap combos, not just pure large cap. So there was a significant increase in Japanese allocation to Indian mid-cap. So when they sold off, mid-caps also got. So that's why today is more a Japan-driven sell-off. The second I would also suspect is that in such a carnage is happening, domestic fund houses, right, whether they be PMS, AIF providers or MFs or insurance companies, who don't want to catch a falling knife. So they are waiting for the market to settle to see how much the fall is going to be before going and buying the stock that they like. But to generate cash to be able to buy the large caps which they want to buy, they have been probably selling mid and small caps today. So that's why. So part of the Japanese money and part of the domestic fund managers reallocating in a diversified fund, in a multi-cap, flexi-cap fund, they have probably been they have been booking profits. And where would they be doing that? They would be doing that where the rise has been the largest. You know, areas like defense, infra, some parts of energy, PSUs have had a massive rally, which is not entirely backed by fundamentals, is more of a future projection. This will happen, that will happen. So all of that, I think there's been a significant of profit booking. So I would say that would continue because when large caps again correct tomorrow and day after, fund managers would like to buy good quality large caps at much cheaper prices. So if the fund manager is going to behave this way, right, they're going to wait and watch and wait to buy. I would suggest that the retail investors do the same. Don't try and catch a falling knife, right? See, if you're doing an SIP, you don't panic. You continue with your SIP or your STP because your rupee cost averaging is going to come to your aid. If you do want to deploy money, put a 1% or 2% of the free cash that you have into the market now. Don't put it all. Spread it out over a period of time because I expect this volatility and this to last for a few days and not to jump in to put all the money in like tomorrow or the day after.
So, right, the advice coming in is wait and watch. Mr. Lokpriya, to you now, what is your outlook on the Indian markets and what would your advice be to investors?
Nupur, I would, Sunil has put it so well that there's nothing much for me to add in the sense, I wouldn't buy, I would wait by the sidelines for some more time, let the market, settle down. And, there is going to be some reallocation of capital between mid and large cap stocks, less about the change in prospects, but more about because fund managers want to reallocate their exposures. And sometimes, in these kind of falls, always markets overshoot, individual stocks overshoot on the downside. And in terms of where India is still strong, is manufacturing is still strong, the PSUs The banks which have reported earnings are still strong. So, the whole theme remains unchanged. Now, and as interest rates start coming down in the US and India, as in a natural cycle of events, again, banks will do well, financial services do well, manufacturing because of lower cost of borrowing benefit. So I think wait a little bit on the sidelines, but again, still it's the same Make in India theme, which will continue to do well.
All right, Madhvi, we have spoken about what's happening in the US markets and the concern about recession. But I had a quick question. Do you think that this prolonged monetary policy, tight monetary policy, in fact, is actually pushing the US towards more of a recession? It's harming them more than they could have perhaps envisaged.
See, to be very fair, I think US has had a very comfortable run. Nobody expected this, right? A year ago, January of last year, if you had checked any of those global CEO surveys, they would have said recession was coming in 2023. They all went wrong. Why? Because fiscal was a massive support. 2024, beginning of the year, nobody would have expected a recession, in the US actually coming, because the sense is always that whatever has happened in the last quarter would continue in the current quarter as well. So we tend to have a very myopic view of the markets or the economy in general. See, to some extent, of course, the monetary policy, when it is too tight, tends to restrict the economy to a large extent. In this case, I think, as I said, fiscal has been a massive support to the US economy, which has led to the golden run in the US macro cycles as well, and also has led to Fed actually not able to catch the cycles right. We are still debating what is the real neutral rate in the post-COVID world, be it India, be it rest of the world. And I think policymakers everywhere are struggling with that answer. To some extent, yes, if the Fed continues to remain tight, given the current macro dynamics, of course, you're going to probably lead to a much, harsher economic realities, than if Fed actually tends to start cutting rate at a stable, steps and probably lead to a more softer landing. Yes, but I think it is unfair to say that a tight monetary policy has led to all of this. Of course, the economy has had a very good run, and incrementally fiscal probably would not have that much support that it gave for 2 years or so. So I think any which way we've sort of stressed the whole recession scenario, and now finally the labor market is now letting off all the heat, and now we are actually getting to see some slowdown, which obviously is a function of policy making to some extent, but not necessarily all.
Right, Mr. Subramaniam, final words on the rising geopolitical tensions. That's something, of course, that's triggering the markets. And we have, through the day today, at least seen a lot of worrying statements coming in from Iran and Israel, both. The US also wading into that debate, warning G7 that there could be an imminent increase in tensions.
Well, yes, it's an overhang, but I would say if the Japanese and the US situation gets clear, the geopolitical tensions shouldn't make a difference to your investing in the Indian stock market, because I think we are fairly insulated from that kind of a tension. In fact, only thing which can worry us is a spike in oil prices. But I have a contra view there, that if at all Iran is getting into a war, he's going to pump more oil to finance the war. So I don't see oil then rising because of that, though there'll be initial spike because of the tension, but the actual supply, and see already Saudi and everybody haven't done the production cuts to the extent they said. So oil looks to be easy. So I wouldn't worry too much about geopolitical from India specific. It's a Japan and the US thing. And even US, like I mentioned in my earlier chat, that ultimately the rate cuts are positive for equities and positive for FI flows into India. To me, it's the Japanese situation, the uncertainty, once that settles down, I think we'll bounce back. And the biggest geopolitical concern was Russia, Ukraine, and that didn't hurt India stock market in any way. So I don't see why this should hurt India. It will have its repercussions on some markets around the world, but not necessarily India, as long as the oil prices are under control. So it's the oil which I would say wait and watch to see on a geopolitical front.
All right. Mr. Lokpriya, any final words about the geopolitics, as well as your sense of how long could we see this volatility now?
It's a couple of things. One is the geopolitics itself. If you look at oil price, the price is there at about $70 odd, so which is a very comfortable number for Indian oil exports. If you look at the basket crude price, it can sustain a much higher number of an oil price. So that is not really a concern now. Second is the general slowdown that we're seeing. There are two different reasons. One is, U.S. consumer has slowed down some amount that is at the lower end of the income, where the inflation is hurting them. In China, all kinds of consumers have slowed down. Whether you've seen Louis Vuitton sales and Cartier sales slow down in China, which has not happened in the US. So the economies have to, the balancing in these different countries is slightly different. And that will have because India being still a domestic-led economy, at least in terms of earnings growth for the next couple of years, I think we're largely fine.
All right. I'm afraid we're running out of time on the big story, but all three of you, thank you very much for joining us this evening. So the word coming from all our experts is wait and watch, and things should be better perhaps sooner rather than later.